Right, lesson 4. Central banks, the core of the financial system. So in this one we will cover the core roles and the tools that different central banks across the world are utilizing to maintain the monetary policies. So the central banks are the hidden architects of the whole global liquidity, okay? They don't just print the money as the majority of people think that central bank is printing the money. That's their job, so to speak. No, they control the cost, the flow, and the rhythm of all money. So every commercial bank depends on them for the reserves, for the rules, and most importantly, for the rescue. So they are the banks of the banks and the issuer of base money and the conductor of the credit cycles. So, what is the difference between the base money and the credit money? So, the base money are created by the central banks, which are the cash plus the reserves. The credit money is created by the commercial banks when they are lending the deposits of the users, so to speak. So when a bank gives a loan, it creates that deposit out of the thin air. Okay, so when you go to the bank and ask for a mortgage or a car loan, or doesn't matter, whatever else it may be, and the bank approves it, so to speak, which is also a big game, right? They check your whole credit history, all of that stuff, to see whether you're gonna return the money or not. But when they approve you, they create the deposit out of the thin air. And that deposit becomes spendable money, backed only by trust and borrower's promise, so to speak. So the central banks, they don't issue this directly. Instead, they control the incentives, interest rates, liquidity conditions, and the collateral standards that decide how much of that invisible credit gets created. So they control the process but not the actual issuance, so to speak. They create the base money, but the whole rest of capital flow, so to speak, is being created through the credit markets and the credit money that is created by the commercial banks out of the thin air. Okay? So the central bank has a specific toolbox, so to speak, and they are able to influence economies through a set of core levers that shape liquidity and the whole risk behavior. So the first one, and the most important one, so to speak, is the policy rate, the price of money, so to speak. This is the main interest rate. So in Fed, this is the Federal Reserve rate. ECB is also, they have their own rate, which is known as the Euribor, ECB interest rates, and they control all of that. And the rest of the central banks, they have their own type of interest rates. Okay, so it sets the tone for borrowing, mortgages, and leverage. When the rate goes up, which means that the central bank is increasing the interest rates, then the borrowing slows and the asset prices fall, right? Because there is no longer a risk-on environment, and central banks, from the very basic high-level perspective, they tend to do that when they have to slow down the economy, so to speak, and they cut interest rates to speed up the economy. So when the interest rates goes down, the borrowing accelerates because borrowing becomes cheaper and the risk assets pump, meaning that the market thinks that it's when the interest rates are being cut down that the stimulus is necessary and liquidity injections are also coming, which signifies the risk-on environment, meaning that money can flow easier towards riskier assets to get better returns, so to speak. And when the rates are going up, usually the money comes back to the country because just by buying and holding bonds and treasuries, right, you are getting better yields, so to speak. When you look from the uh, big perspective on a high level, it's way more complicated when you look deeper, but from the high level perspective, it's as simple as that. Rates up, right? Then the borrowing slows and asset prices fall. Rates going down, borrowing accelerates, and risk assets pump. It's simple, but it's world shaping pretty much. Then, second tool is open market operations. I already been speaking about that. Basically, the buying and selling of the government bonds. Buying bonds equals injecting reserves equal easing. Selling bonds equals to draining reserves, liquidity getting out the market, which is tightening. So long-term QA, the quantitative easing, keeps the rates low by flooding the system with reserves. And the QT, the quantitative tightening, reverses it. It's pulling liquidity out of the system. And this is exactly what's been happening in the US, for example, for quite a while. And just recently, like probably I can't remember exactly, but I would say about 2 to 3 weeks ago, the Fed hinted for the first time in a while that it's actually ending the QT and it's gonna start injecting liquidity into the system, which means that a quantitative easing begins, and there are places to monitor that and see that. And I'm going to show you one example in a minute. Next one, interest on excess reserves. So this tool that a central bank is using is basically stands as the interest the central bank pays the banks to park money safely. Not all of them are using that, but it's one of their tools that they're able to use, so to speak. So when you have high interest on excess reserves, the banks hold liquidity. They keep it parked within the central bank because the central bank is paying good interest rates, so to speak. When it's lower, the banks are willing to lend the money out for people, businesses, mortgages, etc., because they get better returns this way. So this quiet dial, so to speak, it controls the credit flow without the headlines. There is no point in writing all of that media coverage. All of this is happening slowly behind the scenes, so to speak. A central bank controls one part of the interest rates on the excess reserves, and then the banks decide whether they want to lend it out or not. Simple as that. Then we have the repo markets, as I've been describing and explaining before as well. And repo is basically short-term lending with collateral, as I said, usually overnight lending. And if repo rates spike, it means funding stress. So for example, in 2019, the Fed had to inject liquidity overnight to save the repo market, because the repos and that overnight lending is the heartbeat of the whole financial plumbing, so to speak. Moving forward, emergency power. This is another tool that central bank uses, is the lender of the last resort. So when the panic hits and interbank lending freezes, the central bank becomes the lender of the last resort. They are the saviors, so to speak. If it loans against collateral to keep the system alive. So this is how the bank runs are stopped, not by confidence, but by unlimited liquidity that the central bank can provide. But it comes with a cost, the moral hazard, because banks know the safety net exists, right? They often take more risk than they should. And this is the exact reason how the whole 2008 thing began, 2020 market conditions began, so to speak. Of course, some of it was engineered behind the scenes and pre-planned, but still, the bank, especially the big banks, they always know that whatever happens, there is a safety net from the central banks. And most likely you will get saved even if you take a bit more risk, because trust me, banks are greedy. They are so greedy, and the whole system runs on greediness. I had a very good discussion with one person that he used to work as a financial markets trader responsible for the Swiss franc and gold in the trading floor in UK. Trust me, the stories he told me about how they operate, especially from the greediness perspective, spending so much capital, so much money on random stuff that is not necessary, but it's just how the system runs. So if they can make more money and find any angle that is a bit too risky, but nothing extremely out of the ordinary, so to speak, they will do it, because they know that most likely they will be saved in the worst case scenario by the central banks. Moving forward, global coordination and hidden liquidity. So most people think that different countries' central banks act alone. Well, in reality, they don't. In crisis, they coordinate through the swap lines, which is a fairly public information that you can find. So the swap lines are basically the credit pipelines between the countries. For example, once again, 2008 and 2020, the Federal Reserve lent trillions of dollars to foreign central banks. And those banks used the dollars to stabilize their own markets. It's global liquidity management done quietly behind the closed doors. No one needs to know that, especially the media part will not cover that. But the swap lines information and the funds flow is fairly publicly available if you just dive deeper into internet, so to speak, and you can find all of this information yourself, and you will see that it's a pretty often thing that the swap lines are being used between the countries. So when people think that certain countries are fighting, or they are enemies, so to speak, or they are working as competitors, in reality it's not. It's the whole global thing, because the system runs worldwide. The worldwide system of money runs the same way everywhere, pretty much. The little things are different, but the core principle is debt-driven system. So all the banks, they have to act sometimes all together to save the system, because the system needs to keep on running. The system cannot fail, so to speak, because then it's a massive chaos. So central banks are working together in most cases when some sort of crisis, so to speak, hits, to save the system. Simple as that. And pretty much final thing you should understand about central banks is the forward guidance, which is words as weapons. Every little sentence a central banker says is a tool. When they use the words like patience, or data dependent, or higher for longer, these are not empty phrases. Markets move because expectations move. So the traders analyze tone, pauses, and even facial expressions to predict what's next. Is psychological policy. So you know this famous saying right now, when Powell, right, comes to the stage, and his famous good afternoon, right? Even by that, certain algos are trying to understand the tone of his good afternoon, and based on that, they are already making predictions. They have lots of historical data, what kind of statements are coming out based on his tone of the good afternoon saying, and essentially they're trying to predict what's going to happen. And that's why the market usually moves minutes or seconds before the actual event starts to happen, because a little tiny things, when they appear if they are late or not, what kind of tone they're using, etc., is already making predictions and people already betting before it actually happens, right? Now, the mandates and the real world differences, so to speak, because each central banks play a different game for their own surroundings, even though the system itself is based as a one thing, but different countries places based on what they are doing as a country, whether they are focused on exports, imports, whether they are the producer or the receiver, blah blah blah, they play different central banks games as well. So for example, the Federal Reserve, which is the US central bank, so to speak, they have a dual mandate, which is price stability plus employment. That's very important for them. And NFP data is one of the core principles, CPI data as well. ECB Europe is placing price stability above all else because ECB runs all European economies, and they have one interest rate that is covering the whole Eurozone, right? So it's a bit of a different game than the Fed, for example. Bank of Japan, they fight deflation usually and keep the yields near zero. People Bank of China, they control the growth and forex markets under government direction, right? So they are directly influenced by the government decisions, while, for example, ECB and Fed are Fed is way more independent, ECB is a bit more independent, but for example, People Banks of China, they are fully controlled by the Chinese government and they make what they need to make, so to speak, but that's because China is the biggest producer, right? So they have to really control the flows of the foreign currencies and the forex markets, so to speak. Now, their goals between central banks always differ, but the tools are the same. When one tightens, for example, one of the central bank tightens their policy, the global capital flows shift, especially towards the US dollar, right? So they have different goals, but they're using the same tools, the same measures to actually manage the monetary policies across their countries, states, cities, economies, whatsoever. Now, the hidden mechanisms that you have to understand, not the mechanisms or the mechanics, which is sterilization and collateral. So, sterilization means offsetting actions to neutralize liquidity. For example, when a central bank buys forex reserves or foreign reserves but doesn't want inflation, it issues bonds to absorb the extra money, right? This hides the real monetary impact from the public view. The collateral quality is another invisible layer. As banks accept weaker collateral during the credit booms, risk piles up quietly. That's how 2008 thing began, right? When the credit booms and liquidity is injected on an insane scale, the banks, the interbank transactions, they begin to accept weaker and weaker collateral, and the risk piles up really quietly, right? And when that collateral loses value, the funding system collapses overnight. The repo market collapses overnight. And finally, the political side of independence. So the central banks are independent on paper, right? But never fully in practice, because when the governments are drowning in debt, raising rates becomes politically dangerous, so central banks often chooses inflation. They pretend it's data-driven, so to speak, but it's often a fiscal survival disguised as policy. When central bank buys assets, it's transferring risk from private institutions to itself. So the losses don't disappear, they are just hidden in a balance sheet. Nobody audits properly anyway, it's a central bank. That's why central banks now hold over 30 trillion in assets globally, right? Most of it, it's a total BS, so to speak. But the central banks are the buyer of the last resort, the ultimate counterparty. So when they stop buying, liquidity disappears, and that's when the crashes began historically. The moment central banks are stopping with buying the assets and injecting money into the system, the liquidity disappears. That's it. And all the crashes starts this way. And what you have to understand based from this simple high level lesson, my brain is not braiding anymore from so much recording and writing all of the content. What you have to understand is what the central banks are doing at the moment. What is their current stance? That's what you have to monitor and understand where we are in the cycle. So for example, now if we go to the Fed, and there are a page, which is the Fed of course, and I will leave the link down below, maybe a few more links. For example, this is the balance sheet of the Fed, right? The total assets. So what you are seeing right here is basically what is happening. If this chart is increasing in value, so to speak, it means that the Fed is actually injecting liquidity into the market and is buying the assets, right? It is buying and buying and buying. So the risk on environment begins. As you can see, 2008, look what's happened, right? A massive increase, and they've been buying and buying and buying pretty much ever since. Like, not necessarily always buying, but at least it's been on the nice uptrend. Then 2020, another insane situation in the world, and we had a massive injections of liquidity from the Fed. They've been buying the assets, and then towards the mid 2020, the quantitative tightening began, and ever since they've been not buying but actually disloading their assets, right? So this was happening since mid 2022, more or less, and what it meant that first of all the markets were not performing that well, right? And the interest rates remain unchanged and high, so to speak. Now what's happening as we speak, the interest rates from the Fed are being lowered on each meeting. At least for now, the last two meetings, they are cutting the rates, and they are suggesting and announcing the quantitative tightening to be ended and the easing to begin. So they will start injecting once again, right? At least they are kind of suggesting this data based on what they've been speaking. So if this chart now reverses back to the upside and they are starting to buy the assets rather than sell the assets, right? Injecting liquidity into the system, all the asset prices are yet to rise. Okay, so when you look from the crypto and DeFi perspective and you see some sort of a downside momentum, downside movements in the market, and this could be even multiple days of bearish price action, and you start panicking that the bear market begins, well, this is a pretty newbie mistake, because you have to look at the macro, what is happening in the world, especially what is happening at the biggest economies and their central banks policies. And you will notice that the central bank policy for now is actually pre-bull market. They just started the rates cuts, right? And they're just starting to enable the quantitative easing procedures, meaning that the money is yet to be injected and the rates could possibly continue being cut, so the whole risk-on environment is yet to actually happen, right? So any short-term downside swings in crypto market, especially because this is the biggest market to see what's happening with the global risk appetite, right? All of that downside momentum, even if it's multiple day downside momentum, means one thing: manipulation, leverage liquidations, maybe take profits, take profiting, so to speak, by the big guys. But it's definitely not the beginning of the bear market, because you have to look at the macro events, what's happening from the macro perspective. And if the macro is looking good, the rates are being getting down, the liquidity is being injected by the Fed, which is the biggest economy, right? And most crypto friendly as of right now, then if you watch this, then you go to other central banks pages, data, and you look what's happening there. Are they planning to cut the rates, or what kind of balance sheet those central banks owns, etc., etc.? This is just a very high level basic information, right? So I don't want you to attack you with a lot of data and information that is not necessarily necessary. I just want to show you that these things exist, and then you can go and dive deeper yourself, right? Because we're focused on DeFi crypto markets, and market intelligence is understanding that these things exist, how they work, right? But I will not go and explain every single little button on every central bank pages. You can do that yourself on your free time, right? But this is the core idea. When you see certain reactions and movement in the market, think and check what's happening on the macro level before making any assumptions if it's a bear market or a bull market, okay? So that's lesson 4. Thank you for watching, and I will see you on the next one.